Welcome everybody for our capital market development China and Asia. And as always, let me spend 1 minute introducing the speakers and myself. Um, my name is Xiaomin. I'm from PBC School of Finance at Tsinghua University. And today we have one presenter, one discussant. The presenter is Professor Bernie Yang from SUSTech. I believe, Bernie, you're in Shenzhen right now, right?
Hey, I'm in Shenzhen.
Yeah. And the discussant is Alberto Rossi from Georgetown University. And the title of the paper is Digital Transmission of Financial Knowledge Evidence from Stock Market Investment. Now, Bernie, are you ready to go?
Yeah, sure. Yeah. Let me do the sharing. Is the sharing successful?
Yeah, it needs to be full screen.
Is it full screen now?
Yes, it is. Good, perfect.
Let's go. Well, thanks a lot, Xiaoyan, and thanks a lot for attending. And thanks in advance to Roberto. He may have an unexpected. He has an unexpected big event that he is running back, but he may not be in time. So he has done us a favor by pre-recording his discussions, and I look forward to learning from him and from the audience. And again, thanks a lot for joining the seminar. The title of the paper is Digital Transmission of Financial Knowledge, Evidence from the Stock Market. We have 4 co-authors, including Xiaomin, YEUNG, Hachigian, and me. And as a matter of formality, let's say that the views do not represent the view of BIS because this is a required statement. Okay, now let's start. Our research question is, can digital nudging overcome inertia, transmit information and knowledge, and entice people to invest in capital market sensibly? Long ago, almost a decade ago, in 2016, John Campbell drew our attention to that the population does not seem to involve too much in the capital market, and there were many papers explaining why. The very important explanations are like the high transactions cost and also lack of information and knowledge, and also just a behavioral inertia. Given the digitization, we have now very low transactions cost solutions for people to use the platform to invest at very low cost, including the ETF and so on. And also, given the digitization, there are all kinds of wonderful ways to transmit financial information. For example, Alberto ROSSI has the paper, among others, have the paper on robot advisors, and people work on how social media play a function too. So at the end of the day, we have the problem. Transactions cost and lack of financial information seem to be resolved by the digital means. However, the stock market participation puzzle is still very high. The lack of participation is everywhere, including developed country and including countries with very huge smartphone penetration. This graph shows that Japan, 15% participate. China, according to some statistics, is 7%. India is 6%. And so we apply our experiment in China. So let's focus on China. And I vividly remember a really wonderful paper that Charles Jones, together with his co-authors, including Xiaoyan in the audience, they show that 80% of the Chinese population does not participate. And the 14% that participate seems to be seem to exhibit herding behavior. And the lack of stock market participation is particularly prevalent among the older one, the less educated, and the less wealthy. and they face high entry costs, lack of information and knowledge. But these people can really benefit from spreading their wealth beyond just putting them into the piggy bank or putting them into the housing market and so on and so forth. So we ask the question, can digital means reduce entry barriers, overcome behavioral inertia, and transmit knowledge and information so that people can invest in the capital market efficiently and effectively? Since we're using China as an experiment, we look for a digital platform, and I guess most of you will guess what this platform is. This platform has 1 billion users, and it accounts for about 70 to 73% of the Chinese population. And we look at the platform, and it confirmed the stock market participation puzzle. Out of these platforms, 81% had no investment, 14% had somewhere between above zero and less than 100 RMB. And then this is consistent with Xiaomin's paper. Then we look into those that do not invest in any equity, bond, hybrid index, QDII, and so all this. We look at them and we divide them into no investment versus investment. And on the right-hand side, you see 2 bars. The first bar is no investment. The second bar is with investment. Then we divide them into the age bracket, and we find out clearly the picture says that older people are indeed more likely to be in the group of no investment. Second, we look at those with and without college education, and again, look at the no investment bar and the investment bar. And we find out that the no college education people are disproportionately more in the no investment. And then you look at the wealthy versus non-wealthy. We use 50,000 renminbi RMB to differentiate. And again, we show that the data show that the less wealthy are more in the no investment group. We look at the platform. The platform offers inexpensive access to instruments, and it offers, and I'm going to explain, scalable, cost-effective, convenient access to financial information and knowledge. And the platform actually promote its work. Is a commercial advertising activity. It randomly every month, on the 18th of the month, send out a nudging message to tell people about its various investment opportunities as well as the access. So let me show you what I mean. The platform has right now on the screen about inexpensive access. You see various kinds of instruments, and the barrier is very low, even $1. Then what about scalable, low cost, convenient access to financial knowledge and information? Then here is the robot advisory, ready, available. You click and you can get it. Here is a discussion point, a community that you can get all kinds of information. For those who understand the Chinese, you'll see that the information below are discussions of hot topics. Then they also have videos to show you, oh, is gold going crazy, why, and all this. So the platform has all these instruments inexpensively available to the users to learn more about financial information and hot topics and so on and so forth. Then the program is that every 18th of the month, the platform send out a random message. The random message, it varies, but mostly it's about, here is my instruments. Click, take a look. Here are my channels to educate you or to pass you information. Click and take a look. That's all. Then, so now this gives us an opportunity to use this randomly distributed message to check the nudging effect. So, excuse me, let me just get rid of something. So let's use the platform, use the nudging program, and check where the digital nudging will will entice uninitiated households to acquire financial information and increase their investment in capital market, build a diversified portfolio, and attain a well risk-adjusted portfolio performance. And the randomly distributed nudging message allow us to overcome the endogeneity issue, meaning that the acquisition of information is endogenous. And I cannot just use the acquisition of information to explain the outcome. So we need to have the nudging program. So we designed this quasi-experiment in this way. We take the whole population, we screen out and identify only those that first have registered user been on the platform for more than 10 months. Second, they have logged onto the platform. They are active users in the past 2 years, in the past 10 months. They are 18 years old, and they have absolutely no prior investment, not even time deposit. Okay, and they have utterly in the past record received 0 promotional message. So they are the blank group, 0.55 million of them. Then we go to January 18. Out of the blank group, we find those that received the random message. So these are like out of this blank group, and this blank group, I pull a group of patients, and in front of the patient, I put a pill in front of them. Okay, then I go to those that did not receive the message and select another subgroup with identical size. Then the first thing is that I test whether this randomly selected control group's distributional behavior is the same as the treated group, and they are the same. So it validates that the platform, the treated users in the platform, those that receive the pill are really randomly selected. Then we use the constant exact matching to identify matching between the treated and the control. At the end, we lose a few observations. So we have, out of the blank group, we have got 62,000 treated group and 62,000 control group. So imagine that the treated are some patients. You put a pill onto them, then you select another group of patients blindly, but do not put a pill in front of them. Then after you put the pill in front of them, the patient may just look at it and do not touch, or the patient may eat the pill. So eating the pill is like you take action, you respond. And when you respond, there are various ways, because the response is you take the pill and you start to look at either the robot or the communities and so on. So we check the time that they spend on with the robots, with the robot advisors, with the wealth community. So it's about how long they get exposed. Okay, do they swallow the pill or they split the pill out, etc., etc. So we have a way to measure the exposure. Now we are into the DID business. We have the treated group and the control group, and we know their exposure. Then we can regress the nudging. We can regress the exposure on the nudging. The control group has nudging equal to 0, and those exposed group has nudging equal to 1, and we regress the exposure on the predicted value. We predict the exposure based on the nudging dummy, and we used the predicted value to explain the exposure. Again, the exposure is the time spent on visiting the robot advisors and wealth communities and so on and so forth. So now let me just give a summary of the result. 2.1% respond to the nudging. So we call them the first round response, meaning that I received the message and only 2.1 of them will actually touch the pill, eat the pill. Then If we do this, if there are some that receive the message 6 times, the cumulated 6-month experience is that 29% of them will take the pill. Then among those that take the pill, 24% of them will invest with sustained results in the following way. They increase their investment engagement in stock market, mutual funds, and so on and so forth. Their portfolio is balanced. We use diversification measures to show their portfolio diversification. And we also show that their investment performance is actually good in the sense that we look at the abnormal Sharpe ratio, and the abnormal Sharpe ratio has gone up. We further look at how this applies to the older, less educated, and wealthy, the group that really deserve help, and they do. They behave just like the rest. So the nudging program guide people to participate, especially if you are insistent, and they will invest in stock market, they will invest in a diversified portfolio, and the performance has good abnormal Sharpe ratio. To save time, I skip the data and all this descriptive statistics. And this one I show you just to hope to convince you that our instrument, meaning the nudge, is a strong instrument. Then this is the second stage regression, regressing the outcome on the predicted exposure. And we find that the coefficient, this beta, is positive and significant, meaning that the expected exposure explain a higher level of stock market participation and higher equity holding ratio. We also look at the increase in the fund balance, fund number, fund type. All this are diversification measure, and we find out that the expected exposure explained the diversification measures. Then we produce the Sharpe, the abnormal Sharpe ratio, and we again find that the abnormal Sharpe ratio is significantly explained by the predicted platform exposure. At this point, we have to ask, what really is the economic effect? Recall, I said only 2.1% will respond to the nudging. If it's so low, then is the program effective? I'm going to do this in 2 ways. First, I will look at the response, how much do they gain? And then I will look at over time, how many people will respond. Then I look at, for this group, will the good observation persist? So we call those who receive the message and respond. So it's like I put a pill in front of patient, and the patient eat the pill. Then I look at this. Now, there are some patients that just look at the pill and does not touch it. And those this are in this line, those who receive the message but ignore it. This is different. So I'm comparing those that see the message and react. So I call them treated response, compared to those that have not received the message at all. So this comparison identifies the effect of nudging. I repeat, I see the pill, I take it. I have some reaction. With someone that did not take the pill, I compare my reaction to those. And this is how I identify the nudging effect, the economic effect of the nudging. This left-hand side makes a label. It essentially the big vertical bar represent stock market, represent an index on mutual fund participation and stock market participation altogether. The right-hand side represent only investing in equity. And what you see is that the control group is gray, the blue is treated, and but do not take the pill, no response, and the treated but respond is the orange bar. Clearly, the orange bar is statistically significantly and also economically significantly bigger than all the other group, saying that the treated respondents are really responding to the nudging. And then this is the diversification score So maybe this one, this diversification score, somehow this basically capture a measure of the portfolio diversification. It says that those that do not receive the nudging, those that receive the nudging but do not respond have very little change in the diversification. But those that receive the message and participated, they have a much higher diversification score. Then we go to look at the performance in the Sharpe ratio. Again, following the gray in the control. The blue are those that receive the message and no response. The yellow the orange receive the message and respond and participate and look at the robots or the chat groups and so on and so forth. And they have a much higher statistically significant Sharpe ratio, abnormal Sharpe ratio. Now, the first response are doing well. Then let's look at 2.1%. It bothers you. It bothers me. And the co-authors to get together and say, let's look at persistent nudging. So we identify those that receive the same message 2 times in 2 months, 3 times in 3 months, etc. And we look at the first time response. In the 2 months is 2.1. If you send it out, if you receive 2 times, it's 7.2. If you receive this message 6 times, you reach almost 29%. So it says that persistent nudging actually has a positive effect. Then we look at the behavior, compare that react only in the first month versus those that react after 6 nudging. This table, the thing away from this table is that they behave the same. The first time response is always like only 2 to 3%. Those that respond always invest about 32%, participate about 20 to 30%. And then the fund balance increase and the abnormal Sharpe 1 month, 3 months, 6 months, it's always better. And so it says that the program is effective. So if you are willing to do the nudging, if you object to that, the first time response in the first month is low, you can do a more persistent program. The next thing then we look at is about the older, less educated, and the less wealthy. These are the groups that they should really try to put their savings in a better way to grow, to preserve and to grow their savings. So we look at the age group into 18 to 24, 25 to 40, 49, and about 50. Education is with or without college education, and then investable assets. Do you have more than 50,000? This graphs a whole bunch of plotting of the second stage beta, meaning the ability, we do them group by group. We look at the predicted exposure and use the predicted exposure to explain the performance. And the vertical beta plot the coefficient beta. And if it is significantly above 0, it means that it is effective. It is too time consuming to go through them one at a time. But I think it suffices to say that this slide look at stock market participation in various ways. And if we find out that the older one, which is the gray in this, is always significant. The less educated, which is the second row, always significant. And the third one is the poorer, always significant. And something that stands out is the wealthy one, not always non-significant. And that's understandable because they already know the market. They don't need your nudge. They don't need your education. Then the next thing we look at is the portfolio diversification. And all this are diversification measures. And the bars represent the beta again. And if it's about 0, it means it's significant. Again, we find out that the nudging program will lead to more diversification for the older, for the less educated, and for the less wealthy. And then the last bit is really the performance, the abnormal Sharpe. Again, the result is there, saying that the nudging education program lead to to improve the portfolio performance, more participation, more diversification, and the abnormal Sharpe is significantly above zero. Then we looked at how they respond. It turned out that their response rate are the same. You look at old, middle, young, or less educated, more educated, less wealthy, more wealthy. The only exception is that the more wealthy one has a lower response rate, but the rest are all the same. Then you look at their economic effect. So what happened to the person after the person responded to the nudging and do something? We find out that they do raise their stock market participation, and they do increase their wealth. They do increase their wealth fund balance, and this apply to the old, apply to the less educated and the less wealthy. And again, the standout is that the wealthy ones, they don't bother. Okay. Portfolio diversification, again, the same thing, all raise their portfolio diversification. And when it comes to performance, they all raise their abnormal Sharpe. The thing that is like, does persistent nudging work across all groups? We find out that they do. This graph behave graphically identical to the graph that I showed you earlier about the response for the whole group. Now I'm looking at the response to persistent nudging for subgroups, and they're virtually identical. They're almost identical. Then we also look at how long lasting is the performance, 1 month, 3 months, 6 months, and again, they are just all there, significantly above zero, and there's a very impressive set of results. So I want to conclude and say some caveat. Digital performance can host capital market products, provide low entry barriers and low transaction costs. It can connect uninitiated households with investment community, deliver useful financial knowledge and product information, lead to higher participation, diversify the participation, and good risk-adjusted return. And the effect also apply to older, less educated, and less wealthy, those that really can benefit from it. And the policy implication is, yes, this can work, but there are a lot of things we don't know. First, here are the caveat. First, this is a very unusual period of time that the platform, you all know what this platform is under scrutiny. All their nudging message, all that they do are being very closely monitored. So we cannot rule out the possibility that over time that the unscrupulous people will use the nudging program to achieve something that's bad for society. So monitoring and supervision by the government on the content of the communication is very important. The second thing that we don't know is that there exists a lot of ways to do the nudging. We don't know how to make it more effective, and not to channel people to the useless, but channel people to the more useful, more effective communication programs and knowledge transmission program, and to the good products and so on. Okay, I think I will stop here. Thank you very much for listening.
All right, thank you, Bernie. Now, I don't know whether Alberto is already here or not. Maybe not back yet. Therefore, we are going to play a pre-recorded discussion Alberto prepared for Bernie's presentation. We can start.
Good evening, everyone. I'm incredibly sorry, but I will not be able to deliver this in live, given that I was asked to join a last-minute dinner event. But let me just jump into my discussion. It was an absolute pleasure. Thank you so much to the organizer for asking me to discuss this wonderful paper, and I'll just jump right into it. The context is household participation in capital markets. We know that stock market participation is surprisingly limited, and this is true even in advanced economies. There are a number of reasons for that. There's a very large financial literacy literature try to understand whether improving financial literacy improves stock market participation. The answer seems to be yes. But also there is a large literature that tries to understand what is the behavioral inertia that creates obstacles to stock market participation. Now, I think that's what the literature stands. What I think is interesting is that over the last decade, at least, we have that digital platform are coming up, and they're offering a scalable, low-cost alternative to financial educations. But it's not totally clear that they are effective in terms of helping individuals making better decisions, increasing their stock market participations, and their overall financial fitness. So this paper is really about trying to understand whether nudging that leads people to gaining access to financial knowledge digitally can have an effect on their investment activity. In terms of the mechanics, the paper uses a very important platform in China that has over 1 billion users. It leverages a interesting quasi-experimental setting. So on January 18, 2023, the platform randomly sent nudges to a part of their user base, but not others. And so the paper is really about trying to combining this information from the nudges in addition to detailed administrative data on platform interactions and financial behavior. And really the core of the paper is this IV strategy, where you have that the random nudging affect platform exposure in an exogenous way. And so that allows the authors to understand whether platform exposure, the various aspects of platform exposure, affect investment outcomes. Now, in terms of the main results, the authors find that platform exposure has an important impact on stock market participation. It also has an impact on mutual fund balances. It also affects portfolio diversification, and this is kind of measured by some allocation scores and also fund variety. And also, very importantly, there is an impact and effect on risk-adjusted returns. In general, we find that the authors find that the effects are pretty persistent and they are pretty large. And in terms of heterogeneity across user characteristics, the effect seems to be particularly large for less educated individuals, the less wealthy users, the older users. So all those individuals that traditionally have had issues in terms of having structured investment decisions in their own individual portfolios. Okay, so the strength of the paper definitely tackles a very important questions using administrative data. It has a very interesting identification that exploits randomized nudging. The authors are also using a course matching strategy, but I'm not too worried about finding a amenable control group in this case. The sample size is relatively large. You have, in particular for this type of studies, you have tens of thousands of people involved. The measures that the authors use are well estimated, and the performance measures are well constructed. Now you have that another advantage, and this is unlike a lot of these papers in this literature. There is quite a bit of a time series for the authors to estimate the long run effects. I mean, of course, in the long run effects in this fintech world, there's always measured in months, not years. But I think it's very valuable, and the heterogeneity across demographics is important. So, of course, this paper has rich implications for democratization of financial services. You know, we are in a entering a world where the delivery of these financial services, financial advisors, and overall knowledge dissemination is their costs are going down, and this is great from the point of view of helping the less wealthy having well-behaved and well-formed portfolio strategies in their investment decisions. Now, once again, Over-Evaluation is a fascinating paper. It's clearly well written and executed. It's going to be a very important contribution to the digital finance literature. I'm going to have a set of comments related to 5 dimensions. I'm going to start with commenting on the nature of the nudge and the nudge timing and history. And this is really about trying to have the authors maybe give us a little bit more details as to what this nudging really is, and maybe work in heterogeneity and some heterogeneity effects across those dimensions. Then I'm going to have a comment on the heterogeneity in effects across channels. One comment on the economic magnitudes of the abnormal Sharpe ratios. Then I have a comment on the institutional details. It's not really the institutional, but more the setting of China and the aggregate market in China, and maybe how that affects the type of financial advice that we should deliver to individuals in China compared to the US. But I'll get to this. Now, in terms of the first comment, what is the nudge about? Now, the authors describe the nudge as something that is delivered through pop-ups during monthly Wealth Festival, but I don't think it's described, the nudge is not described in precisely enough. And there are many different ways of doing this nudging that may have quite different channels. Like, for example, it could be that the nudge was educational. So maybe the messaging was learn how mutual funds work. On the other hand, it could be that it was product oriented, something along the lines of explore today's top funds. Or it could have been something that was exploiting peer pressure or social dynamics. So sometimes, in many cases, in some of these apps, the messaging is along the lines of, many other clients are working with us or investing with us today, join them. Or it could be behavioral, trying to diminish the inertia by saying, don't miss your chance to grow your wealth today. So right now, I don't know how much heterogeneity there is in these pop-ups. All the nudges are treated as one IV, which I think is the right thing to do as a first pass, but so whether it is received or not. But I would, if I was the authors, I would definitely consider possibly in future work trying to build on this and maybe trying to understand whether which type of nudges are more effective at triggering the engagement. Do the different messages lead to different learning or behaviors, and whether there is an effect, for example, on the whether the educational or the persuasive nudges lead to different outcomes. Now, there is also a relatively important point here related to the exclusion restriction. If you think about it, by the way that the results were described, the change in behavior should only occur through the platform tool, so the robo-advisor or the forum, and not the content of the nudge. And so it could be that some of these nudges, depending on what channel they do, they may affect the behavior, so they may violate some of the exclusion restrictions. So I think it's just important to maybe be a little bit more precise as to how they are delivered and what the content is of these nudges. Now, the second comment is about timing. So if I understand correctly, so the authors are focusing on the January 2023 campaign, but the platform sends a digital nudge on the 18th of every month, if I understand, or even before January. So it could be that some of these users were nudged before. So it could be that some repeat recipients might have developed awareness because they've received this multiple times, and some, of course, the non-respondents may differ from the first-time recipients. So I think this actually opens an interesting angle, which is, is generally truly a first exposure or the moment where prior nudging finally worked. And it's not clear how you want to think about it, but I think it's definitely worth it to be more careful in explaining exactly the timing of these nudges. And because this has some implication for the identification, right? So, for example, you have the exclusion restriction may be affected. So it could be that prior nudges may already affect the intent to invest. It could also be that some of these prior nudges may affect the first stage. So it could be that past exposure could affect the January's effect. And you could also potentially contaminate some of the effects for the controls because some of the controls may have been nudged before. You could also think about potentially selection in a sense that non-respondents to past nudges may systematically differ from those that do respond. And finally, you have that the interpretation may be slightly different because the effect of the nudge may be the effect of cumulative persuasion rather than a single nudge. Now, once again, it's not clear how, to me, it could be argued maybe that some of these effects may bias results against finding something. So it could be that some of the results that are found here are lower bounds of the true effect. But I think it's just worth it to have a discussion about the nudge timing. And once again, maybe I'm getting it wrong. Maybe this nudge just started in January, but it seems to me that by the way it was described, some of the effects, some of the nudging could have been happening in the previous months as well. Now, let me go to the third comment, which is the heterogeneous effects across channels. I think that this is really one of the most interesting results. I think it's underemphasized. It's in the paper is underemphasized. I think also in the presentation, it's not stressed too much, but I think it's fascinating because what this is telling you is that visual content appears the most influential across outcomes. This is, I'm reporting the results across in this figure of participation, equity share, balance, and automation. But this is true across the board. So this suggests that users may learn better through engaging formats rather than structure a robot advisory tool, for example. I mean, if you look at this plot, you'll see that the effect of the overall platform exposure is over here. You have that robot advising is statistically safe, but small. And then you have this very large effect for the forum of the visual content being the largest ones. Now, one thing that I encourage the author is to describe a little bit better, or at least comment why some of these confidence bands are so large. Is it the amount of time? Is it the number of the sample size for the individuals that use the visual content? Is the number lower? But I think that it's worth it to have a broader discussion about this in the actual paper. But I think that this opens up a very interesting thing, which is, I think it would be very interesting to decompose the treatment. I think this is actually one of the few examples where the platform really bundles multiple interventions simultaneously, but the visual effect shows us the stronger one. And the question is, why is it really the case? Is it really because it's easier to understand for lower literature users? Is it because it's more persuasive and engaging? Is it because the content is different? And I think it will be very interesting to understand really what is driving the effect. So it could be that the story is a pure information transmission, so learning about diversification. It could be that it's all about reduction in search and transaction costs. It could be that this is all peer effects from the community, or this could be maybe like, once again, the algorithmic nudging towards a specific product. So all I'm trying to say is that there are a lot of potential channels here. This is the typical instance where I think it would be very valuable to have a survey, maybe on comprehension, motivation for actions. Ideally, you would want to do it on the same users. Of course, this may be complicated. Also, having it in the lab may be a solution. So I maybe try trying going down that route. I know that it could be time consuming, but I think it could add a lot because this is one setting that is very unique to this paper. Now, related to this, and this is, of course, given that I've been thinking quite a bit about robot advice, if you noticed, you have that the results for the personalized robot advice were the ones that were, of course, very significant, but they were small. And I think that one aspect where the authors could do more is to add some details regarding the personalized robot advisor. I'm saying this because there are quite different ways to do robot advice, right? On the one hand, you have some robot advisors that really should be called robot managers. The way they operate is that you sign up into a plan. Like if you do in the US, at least you sign up for Wealthfront, Betterment, and so on and so forth. What happens is that you sign up for a certain service, and this service is going to re-optimize the portfolio for you, and it's going to be really on autopilot. So effectively, the way these robo managers are constructed is that it creates effectively a well-diversified portfolio across ETFs, or sometimes they do direct indexing, so across stocks, but there's not going to be a lot of user input. On the other hand, robo advisors are more like portfolio optimizers, where you, every time you request information, they're going to give you some suggestion, but then the final decision is left to the users. So understanding what kind of personalized robo advisor is at play here, is implemented here, may be valuable for understanding which model applies in terms of mechanism. Now, the fourth comment I have is related to Sharpe ratios and economic magnitudes. Now, the results, the paper right now are showing very large gains in abnormal Sharpe ratios, but I think it would be valuable to also report some of the results in terms of raw Sharpe ratios, just to understand the economic impact. Why am I saying this? I'm saying this because, like, if I think about the US, I'm thinking that the Sharpe ratio should be around 0.5. Annualized Sharpe ratio is around 0.5. And so some of these results in 1 month, 3 months, and 6 months, the improvement seems very, very large. But so it's not clear to me what was the Sharpe ratio of, for example, the aggregate market. So I think that just providing some context related to this, maybe presenting some of the heterogeneity in the improvement of the Sharpe ratio may be valuable, just for the reader to understand what is the type of magnitude that we're talking about. Now, the last point I want to talk about is the idea of passive investing in China, and I'm going to go on a little rant here. Now, like, this paper is great in terms of adoption of mutual fund. I think that every time I think about financial advice, at least in the US, I always start with this idea that we're in a world where passive funds are really probably the right choice for the majority of the individuals because net of fees, they deliver very good performance. And so active managers, net of fees, they've not performed particularly well. So I'm thinking that the average person that invests in passive funds historically have had an equity premium of 6-7%. There is really not much of a benefit from going active. And so most of the robo-advisory or most of the advice seems to be pretty straightforward, at least in the US. But China is different, right? So China is instead a world where the market has not delivered particularly large equity premium. And it's also a world where you have the passive investments have done, or passive funds have done poorly compared to active funds. Then instead, my understanding is have delivered significant alpha. So from that perspective, like, this is a very different world compared to what we see in the US. So I think that a brief discussion, I think, in talking about this cross-country differences may be really valuable, but I think broadly speaking, there could be something there in terms of trying to figure out whether this is really the right type of advice. Look, having individuals into passive funds, and I don't know if this is exactly what is recommended there, but trying to understand what is the type of advice that should be delivered in places like China as opposed to the US is it's something that I think is very interesting from a point of view of understanding the cross-country differences. Now, let me conclude. So I think that this paper delivers a timely and rigorous contribution to understanding how digital tools can promote financial inclusion. The evidence is very clearly done. So digital nudging and platform-based exposure education can really have a big impact on investment behavior. This is particularly true for individuals that are belong to demographics that traditionally have been underserved in financial markets. And so I think that it really opens up exciting avenues for future work in trying to understand, for example, the message design, the delivery channels, and what are the effects of long-term financial well-being. So overall, I think that this was definitely a very interesting paper, and I applaud the authors for a very interesting piece of work. Thank you so much, and enjoy the rest of your day.
I want to ask, are there any questions from the panelists? Okay, Paul, you can go ahead. Go ahead.
Okay, if you don't mind, but should Bernard? Okay, but
yeah, Bernie, you want to respond briefly, or you want to hear what Paul wants to say?
Okay, let me be brief. First, I am very grateful for Alberto's very constructive comments. I want to clarify one thing, that our controls have utterly received no nudging message before. And in our work, when we put in the control, we ascertain that any time when we run those DIDs and so on, the control have received no nudging message ever, based on the history of the platform. The second thing is that I find the suggestions are right on target. I love them, and I'll follow up, including number one, we need to elaborate more on the nudging in the writing. And then in the future, there's an opportunity to differentiate different types of nudging. And so far, we are very shy in pointing out what the nudging message is about, other than just saying that they just palm the audience to just click open this or that. So I thank Alberto, right on target about this nudging thing. Understanding the nudging. The second thing, the effectiveness across various channels. I thank him for that. We discussed this before. The visual effect is particularly impressive, and he pointed out to us before in the presentation. We did not talk about it because I have only 25 minutes. In the paper, we did not put too much into it because we want to reserve space for a sequence of follow-up papers along the line exactly as Roberto suggested. Then the third thing is about, I really like the point about the robot advisors or managers, and we'll follow on that. Maybe he's an expert on this, and I benefit a lot from his comment, and I think it's something that not just me, but anyone will find it worthwhile to pursue a better understanding of this comparison between US and China, and the role of the robot manager or advisor. Thank you.
Thank you. Now, Paul, you can speak.
Yeah. Let me echo 2 points of Alberto's comment and then offer my thought. The first is I like the idea about heterogeneity of nudges, right? Because in current setting, you treat all nudges the same, or treat bunches of nudges to be the same, but you could probably come up with some heterogeneity for that. And the second, for the Sharpe ratio, maybe the Sharpe ratio you are calculating for 1 month Sharpe ratio is use daily data. maybe that's why the number look a little bit odd to Alberto. Now, for my own thought, I think I keep thinking, what's the optimal level of nudging? Because currently, as usual, right, the more nudging is better for users in general. And I wonder if you can calculate, like, what's the I believe you must have the data, right? What's the optimal level of nudging? Because once you exceed to a certain level, then you will be totally treated as a pure noise. Because otherwise, it's like for the company, keep nudging. It's good for the company, good for the user. So it's like no one is losing. So it seems too good to be true, right? So I wonder if you can also talk about optimality of nudging. Yeah.
Thank you. I bring this together with Alberto's suggestion about elaborating more on the nudging in this paper, and this is a research direction, a research project that we need to dig further into. What form of nudging, what is effective, what is annoying, and what is optimal, and what is counterproductive. So I don't have an answer, but rest be assured that myself and other people may be working on it. Maybe some are already working on it. Thank you for your comment.
All right. I have a couple of comments, Bernie. I feel like the current title, which is Digital Transmission of Financial Knowledge, Evidence from Stock Market Investment, I feel that title is less exciting than digital nudging. You see, when you were presenting for the you did 26 minutes, you mentioned nudging at least 50 times. I think, when Alberto discussed the paper, he also mentioned nudging so many times. Now, nudging is a very big deal in behavioral finance. I put a digital nudging in front of it because not only you're answering nudging, you are also talking about a digital nudging. That's my first comment. I think it can be more exciting and capture the big contribution of the paper. And my second comment is, if you put digital nudging as the title, the whole paper can be organized around it. And I know, Bernie, the thing is, if we're looking at digital nudging, the design, which Alberto asked a lot about, is very important. Whether it's messaging, whether it's videos, whether you give some knowledge, or you have a one-button solution for every single user. So that's designing, and mechanism and the results. They're all putting together very nicely. And I also want to mention something else I was thinking when you were presenting. Now, nudging as a parent, with teenager kids, you want to be optimistic, you nudge them, right? Instead of being angry with them. But, digital nudging compared to regular nudging, it's persistent, it's free, it can be targeted. Does that make a digital nudging more effective than regular nudging? So when I listen to the presentation, I become a more confident parent. Well, it takes 6 times and half a year to get to 0.1 or to 20 something percent. I think this is a highlight of the paper. So how do you overcome the inertia? So it's a persistent nudging, and the design is very important. Those are just my 2 cents. What do you think, Bernie?
Well, thank you for that. We will contemplate, we'll think about how, whether to change the title or not, and also maybe change the tune of the nudging, to emphasize it a bit more. Honestly, there is another paper about nudging, but we think that the two papers are too similar, and because Xiaomin is going on the market, and we do not want to create the impression that we are writing similar things in multiple ways. So we combined everything into one paper. However, your suggestion is very well taken. We need to think about how to change the title and also
Mhm.
raise the voice level a little bit, the noise level a little bit about the contribution of nudging. I myself would confess that we thought about the nudging. We think the behavioral inertia is very important, but I myself do not know enough about this literature. And I think my co-authors will say the same. We probably have to consult you a bit more about how to do the follow-up as well as how to
Mhm.
improve the current pitching.
Mhm.
Nudging itself is a very, very serious topic. Someone won the Nobel Prize.
Yeah. Yeah, I know. I know. All right. Let me see. I think that's pretty much all the questions. And Bernie, it's a very nice and insightful presentation. Thank you very much. And for the audience here and for the arrangement of next webinar, we are still in the process of selecting papers. We will let you know in near future. And thank you very much for everybody's participation. And thank you, and I hope to see you next time in a month. All right.
Thank you,
you,
everyone. Thank you, Xiaoyan. Thank you all. And I'll write to Alberto to thank him.
Okay,
Thank
great.
you.
Thank
All
you.
right.
Thank you, Xiaoyan.